All right, we got some massive news for stock market investors as the minutes of the latest Federal Reserve meeting indicates that there is little support for cutting interest rates anytime soon. So I'm going to discuss the details of what was learned from those Federal Reserve minutes and what it can mean for stock market investors. Let's take a look at the details.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so only a couple of officials at the Federal Reserve's June 17th and 18th meeting said they felt interest rates could be reduced as soon as this month, with most policymakers remaining worried about the inflationary pressure they expect to come from President Donald Trump's use of import taxes to reshape global trade. Now, already, even before tariffs were introduced by President Donald Trump, the inflation rate in the United States was above the target level. And the target level is set by the Federal Reserve, which is around 2%. They set that target because they believe that's a healthy rate of inflation for the economy. They don't want to set the rate at 0% because that's dangerously close to deflation. Okay. You might be asking, why do they want any inflation at all? And let me explain that briefly. So, if consumers are not seeing prices increasing, and in fact, if they're seeing the opposite, let's say you observe the market and every month the car you're interested in buying, the price of that car keeps going down. So every month you're incentivized to wait longer before buying that car because next month it's going to be priced even lower. And the month after that, even lower. So with deflation, it incentivizes consumers to hold off on spending, pull back on spending, and that contracts economic activity, which of course will lead to lower jobs and lower economic output and be bad for everyone in the economy. And so the Federal Reserve wants some degree of inflation, and they feel 2% is enough away from 0% to stop that kind of behavior. And in fact, do a little bit of the opposite because consumers will see prices going up and they'll see an incentive to go ahead and buy right now instead of waiting to buy something later. And of course, the United States is a consumer based economy. Without consumers buying things, there will be a lot fewer jobs. And so the Federal Reserve, one of their mandates, they have two mandates, right? I mentioned one of them being inflation at roughly 2%. The other mandate is to keep unemployment levels relatively stable and low. And so they have to balance the two sides of that equation. You could get unemployment really, really low if you don't care about inflation at all and you let inflation go above 2% and you let the economy overheat and job growth will persist and inflation will increase, right? But then that puts the economy at risk of having much higher prices, which comes with its own problems, right? So you have to have stability, and that's what the Federal Reserve wants to do. Now, of course, uh, President Donald Trump's tariffs threaten to increase inflation because tariffs are a tax on businesses that are importing things from outside the United States. So if Apple imports an iPhone from China, Apple pays a higher cost of that import because of the added tariff on that transaction. So then that means that Apple is paying a higher cost for iPhones. Then they have to make a choice. Do they absorb that higher cost or do they raise the price of iPhones that consumers pay so that they can recoup their profit margin? And so, most likely, Apple will raise their price on iPhones at least to some degree, which then creates an increase in the cost of goods of things that people buy, which then creates inflation. So, already before the tariffs were announced, we had inflation above the target level. And now, when you add tariffs on top of that, you threaten to increase inflation even further. So, the central bank is concerned with that risk. And so, they're not interested in cutting interest rates anytime soon. They want to wait and see the impacts of the tariffs because it's not for certain that it's going to increase inflation. It's only a risk that it could increase inflation. There are many moving parts when you announce tariffs that implicate inflation could move in any various forms and any various directions, right? One thing we've noticed is as a result of the tariffs, the price of oil has declined significantly because investors in that commodity have realized that we're going to experience slower economic output. And if economies are producing fewer things and we have slower economic output, the demand for oil will fall. And so the price of oil has already declined. Well, oil is one of the major components in the cost of everything. And so with the decline in the price of oil, the inflation rate might decline. So there's a lot of moving parts. Nothing is guaranteed. There's just increased risk because of all the extra volatility. And so the central bank is taking a more cautious approach. And of course, the president is not happy with that. The president wants lower interest rates. So Trump has demanded immediate steep cuts and called for the chairman to resign. But the minute showed only narrow support for a near term reduction in borrowing costs, with some policymakers feeling that no rate cut would be needed at all. Several policymakers felt the current policy rate may not be that far above the neutral level, and that's a interest rate that doesn't increase or decrease economic activity. That's the neutral rate, right? So right now, the interest rates at above 4%, I believe, are above the neutral rate, which is estimated to be between 3 and 3.5%. And so the Federal Reserve is trying to contract economic activity to bring inflation down because, as I mentioned earlier, it's above the target rate. And if you're wondering why the president wants lower interest rates, I think every president wants lower interest rates because lower interest rates means increase in economic activity. Most people, when they go to buy things related to interest rates, look at the monthly payment, and interest rates are a big component of that. When you go to buy a car, if the interest rate is higher, your monthly payment is going to be higher, and so fewer people will be interested in buying cars. If you go to buy a home, if the mortgage rate is higher, your monthly payment is higher, and you'll be less interested in buying a home. And these things create a lot of economic activity when people buy a home and buy a car, creates a lot of jobs and it creates a lot of economic activity. And whoever is the president during times of increasing economic activity usually gets credit for the increase in economic activity. So the president wants lower interest rates so that there will be an increase in economic activity. So the president will get credit for a better economy, right? Nearly every president from today back through hundreds of years has wanted lower interest rates, has wanted better economic activity. President Trump is just more vocal in asking for lower interest rates. Other presidents have been more hesitant to directly ask for lower interest rates because of the appearance of meddling with Federal Reserve policy. So after these minutes were published, traders stuck to bets that the Fed will likely cut interest rates by 50 basis points by the end of this year. So in other words, investors are expecting the Federal Reserve to cut interest rates by 0.5% by the end of this year. Whether that be two 25 basis point cuts or one 50 basis point cut remains to be seen. But investors expect the central bank to cut interest rates later this year. And it's because they expect slower economic activity, right? In the first half of the year, we've had almost every month of over 100,000 job gains. They expect that will slow down. They expect there is a greater risk of slower hiring as businesses really hunker down, tighten their belts, and prepare for slower economic activity. And as the job gains slow down, the unemployment rate is likely to increase. And that's the other side of the central bank's mandate, is to keep unemployment relatively stable and relatively low. So as they observe those increases in unemployment, the central bank will try and decrease interest rates so that they can boost economic activity to some degree. So typically, the relationship is inverse with interest rates and stocks because investors have a choice what they can do with their money. They can either invest in stocks or they can invest in bonds, and more specifically government bonds. And the central bank policy is very connected to the interest rates on government bonds. So investors, like right now, can see that they can get 4, almost 5% investing in government bonds. That's an attractive option for investors at relatively zero risk if you go with the inflation protected bonds that are on offer. And so if interest rates decline and the rates on government bonds decline, it makes stocks more attractive because the alternative is a lower rate of return. And so a lot of the investors, including myself, when we're valuing businesses, we incorporate that discount rate because that's an option for us to use with our money. And so this is big news for stock market investors. The Federal Reserve likely to keep interest rates where they are when they meet later in July, but still likely to lower interest rates in the back half of the year as a result of slower economic activity. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.